Hello and welcome to FidelityConnects. I'm Pamela Ritchie. The Bank of Canada and the Federal Reserve have made their final interest rate calls for the year. Canada held steady, while the Fed slashed their benchmark rate by 25 basis points. And while sentiment around Canada has been pretty gloomy, actually, the data tells a pretty different story. Canada has actually been the best performing equity market this year, I think we all know. So with the Fed signaling patience and a potentially very different looking central bank leadership on the horizon, what do all of these central bank maneuvers mean for markets as we head into next year? Joining us here today to discuss rates, personalities, how the Global Asset Allocation team is positioning heading into the new year is Institutional Portfolio Manager Ilan Kolet. Warm welcome to you. Good to see you.
Very nice to see you as well.
Towards the end of the year, here we are.
Finally here.
Glad to have you help sum it all up for us. We'll just remind everyone that this discussion has live French audio interpretation, so please go ahead and join us in either official language. We'd love that. So, and send your questions in as well. Ilan, what was the most interesting thing out of, maybe not the maneuvers or the rate announcements, but the discussion of the lineup of what was important to the central banks?
Yeah, I mean, I think back to a Connects that I did at the start of this year, where I said for the Fed and the Bank of Canada, they would both love to be done, right? And I said they would love to be done because inflation was not really where they wanted it to be. And if inflation is not exactly where you want it to be and the labor market is kind of hanging in there, you don't cut rates. And sure enough, we saw cuts since then. And what has happened? It's really issues in the labor market. Now, those are slightly different between the US and Canada, but the unemployment rate in both countries has drifted higher. And there was, there are signs of stress in certain areas. But I would say particularly in the US right now, the tone of the message yesterday was really, I would say, shoring up the labor market weakness. It's a little bit difficult to read right now, as we know, because of the lack of data. But in Canada, the story was a little bit different, right? So in Canada, again, in the US, we saw a 25 basis point cut. In Canada, we saw a pause. And I think this will result in a prolonged pause for probably much of next year. But really, in Canada, the data has actually improved quite a bit, right? And specifically on the employment side.
Okay, so let's go into that. But does it sound like the rate cutting, I mean, if you had to make a broad statement, is the rate cutting cycle over?
I mean, the most honest answer to that, and maybe it's a bit dangerous to be that honest, is I don't know.
Okay.
And neither does the Fed, and neither does the bank,
No.
and neither do the experts on TV or in the newspapers.
No.
They are taking a data-dependent approach, right? And so what Powell said, so if we think about the Fed first, what Powell said, and I wrote this down, I have a cheat sheet.
Please.
The Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves. So broad range of estimates of neutral, he said a few times in the press conference as well, right? And what this means is, again, we should go back to that data-dependent mantra, which is they're waiting to see what the assessment of the data is like. Nothing is preordained, to borrow an old line from then Governor Mark Carney, and they're going to take this data-dependent approach to assess whether or not to continue to cut or to pause. I would say the next move for the Fed is very unlikely to be a hike.
Yes, and he said that.
Right,
He said that.
and
he's like, nobody here thinks the next move
no,
is a hike.
right,
He actually said that.
Exactly. And so the Fed has cut by 175 basis points since their peak. There's about 50 basis points of cut priced in between, sort of towards the end of next year, September 2026. But those move around a lot, right? As we know,
Sure.
As the data flow changes, those expectations and probabilities change as well. So at this point, I would say, I always say take the governor of a central bank at their word,
Sure.
right? They have no incentive, they're not incentivized at all in any way to pull a fast one. Right?
No.
And so they are, and the conversations you have with them in private are similar to the ones on how they speak in public. They are trying to be as informative and helpful as possible. And that's what both Governor Macklem and Chair Powell did.
Did you find, we also heard from the ECB this morning as well, but is it fair to say, I'm sorry, all these broad comments out here and seeing whether you agree with them, but all central banks, or many central banks, global central banks, seem to be adjusting their growth forecasts up. I mean, this,
Yeah.
in a way, this is like just shockingly good news, considering we mentioned we're gloomy on the way in here. I mean, this is literally the reverse of that. It appears from central bank forecasting discussions.
Right. So, you know, I follow forecast revisions really closely. So it's a fascinating thing to follow because sometimes the direction and magnitude of a forecast revision can tell you more about kind of almost momentum from an economist's perspective than just the forecast itself. And if we're being honest with ourselves, you know, it has not been as disastrous as we would have expected, right? So if I rewind,
it almost hurts to say that,
I mean,
doesn't it?
right,
But it does seem like it's going to be okay.
You know, I mean, you have to be honest with your assessments and where they were. And again, I think back to that April monetary policy report from the Bank of Canada, right, where they talked about the tariffs and they came up with two scenarios, which they very creatively labeled scenario 1 and scenario 2.
Yeah, no forecast scenarios.
Right, you know, right, and they talked about scenario 1 being a significant slowing in the Canadian economy, tariffs are negotiated away, and then growth comes back. And scenario 2 was an absolute mess, right? It was 25% tariffs on everything forever, a multi-year declines in GDP, and that's associated with huge amounts of job loss and an upward shock to inflation. Really just a complete mess from an economy perspective. And if we're being honest, there has been, I mean, the tariffs have certainly shown up in the data, but as we discussed in our last thought leadership paper, and as we're positioned for, the worst may be behind us, right? So things sort of may be darkest before the dawn, right? So I think back to not the most recent GDP report, but the one before that. Mm-hmm.
So
we saw
September,
right? So we saw, you know, we saw a really significant decline in exports.
Yes. Yes,
right?
Which we almost sort of expected.
We were kind of prepping for, right?
The tariff story was meant to work its way through.
So tariffs fell off a cliff.
Yeah.
And in the next GDP report,
or trade, yeah.
Sorry, yeah, and in the next GDP report, they kind of stabilized and kind of hooked higher, right? So the level of exports is still much lower than where it was, but that's one example. Another example is, you know, for the last few years, we've been talking about Canadians being over their skis on debt, and that debt renewing at higher rates, right? And that expected to be quite painful, and it certainly was for some households. I don't want to diminish that, but we're sort of on the other end of that, right? So my colleague David Tulk has described it as the pig is almost through the python. It's a bit graphic, but what we mean by that is rates are declining. Our rates have fallen. I mean, the bank has cut by 275 basis points cumulatively since its peak, and most Canadian households are now on the other side of that really painful mortgage reset, right? So again, the way that we're positioned right now is, for the first time in 13 years, I think, we're neutral Canada. We're cautiously optimistic that the worst may be right behind us. So it'll be interesting to see how this plays out.
It's absolutely incredible. Okay, but let's go into the asset allocation. We'll come back to the labor picture because that's very important to everything that we're talking about. Mm-hmm. But a neutral on Canada means that the underweight is gone. You've been working towards this for some time. You've also been working towards international for some time and tilting just a bit out of the concentration of U.S. equities for some time. Tell us sort of where you are now. What has culminated?
Sure. Yeah. I mean, this is critical for us to discuss. And I always want to discuss this. The first thing I want to do when I discuss this is explain what it means and what it doesn't mean.
Okay.
Right. So if I think about our main, the main fund that we use to communicate, our global balanced managed portfolio, globally diversified 60-40 portfolio, stocks and bonds, 21% of that fund is Canadian equities. And for the last 13 years, we have trimmed that exposure down to 15, 14 at times, and taken that 5 or 6% away from Canada and allocated it elsewhere, principally in the US. And that was absolutely the right thing to do, right?
Yes,
so
yes, it was. Yeah.
Between 2014 and 2024, the US decidedly outperformed Canada. But people forget that from 2004 to 2014, Canada outperformed the US, right? And we forget this because, the US had a 1 in 100 year financial crisis, right?
That's right.
Almost 10 million Americans lost their jobs, so huge negative. And Canada had the commodity super cycle, right? I was at the bank at the time. I remember it well. And I was covering commodities. We believe that right now, it's this long period of Canadian equity underperformance may be coming to an end. And again, we're cautiously optimistic. Now, what that means is we're not leaning in. So the 21 is not a 25, but it's not a 15 either, right? The 21 is a 21.
And what are you waiting to see?
Well,
to make it an over, or what would it take?
So where is the cautious optimism placed? I would say that there's a few spots. So, and this has as much to do with our concern around the US as with what's happening in Canada.
Okay.
So a couple that I've hit on is, the worst may be behind us, right? So we talked about the trade, we talked about the mortgage rate resets. Another great example is resource extraction, right? So between 2014 and like 22, the inflation-adjusted oil and gas capex in Canada fell by 50%, 50%.
I mean, the taps just turned off.
I have no idea how it comes out of the ground, but they turned off the taps, or they stopped putting straws in the ground, or however it comes out. It used to account for 1 in every $10 of Canadian capex, and by 21, 22, it was it used to account for 1 in 3.
Yep.
Now it's 1 in 10. So, to borrow a line from Mark Schmale is, you can add a lot of value and a lot of basis points when things are going from very bad to bad. Right? And if Canada has been priced for very bad, but things get less bad, right? Again, if that 50% decline just flattens out or goes slightly higher, this is a great opportunity for our security selectors, right?
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So broadly, from an economic perspective, do we see a commodities story attracting money out of the housing market, which is where it went to sort of couch itself for zero interest rate over a decade?
Yeah, I mean, capital will flow. I mean, the way we talk about this all the time amongst us, capital will flow to where it receives the best risk-adjusted return. And in Canada, it has been the housing market, right? So, since 2010, well, really post-financial crisis, rates were lowered. And then Canadians did what low rates incentivize you to do, right? So they heaped on debt, but they also invested in condos, right? And so too much of the growth in Canada was one thing, which is highly unproductive, which is the housing sector. Whereas in the US, it wasn't as skewed, right? The global financial crisis emanated from the housing market, right? So that took very, very long to heal. But you saw investment into other things, right? And so, for example, the cumulative increase in capital spending in CapEx in the US from 2010 to now is 70%, roughly 70% increase. In Canada, it's 8%, right?
Not 80.
No, 8%, right? So again, you can just imagine the alligator jaws when you think about that chart.
Wow.
A lot of people think that the productivity and the AI boom that we're seeing right now has come out of nowhere. That's not the case. It's come from 15 years of, constructive investment instead of plowing money into the housing market.
So with your cautious optimism on Canada, how does the productivity story help sway that to a growthier market for other parts of the economy?
So what do we need to see in Canada? Again, if we may be at the worst, or the worst may be just behind us. Again, we work with our teams down in Boston very closely. Our asset allocation research team believes that recession probabilities in Canada have declined meaningfully. We were basically flirting with recession for the last, post-COVID, basically. And flat growth for a long time can be just as bad as as negative growth, right? Almost worse, maybe.
Because it's longer.
It's longer, and it's kind of, as we talked about earlier, like we've all had this kind of Eeyore mentality of like nothing's going to get any better and things are.
You mean Canadians broadly?
Right.
Yeah.
right. And I mean, and sort of some of that's got to be like the seasonal adjustment, but I would say we're cautiously optimistic, and we're cautiously optimistic also on the direction of fiscal policy, right? Yeah. So I know this is a touchy subject, but if we get capital spending projects started and even better completed that aren't building condos, this should improve
Jobs.
productivity, and growth, right? And we can't be picky, right? So in general in Canada, sort of have two sectors, right? We dig stuff out of the ground and we sell it to our neighbors, and we work in our industry, right? Finance, right?
Yeah.
Finance, so we need to get growth moving, and without capital spending and capital investment, we will not have sustained growth.
How does Canada look to the rest of the world right now as an investment opportunity?
Yeah, I still think I'm not sure the consensus is quite at the point where we're at, which is an advantage for us.
Yeah.
A lot of international investors or international institutional investors kind of view Canada with a bit of an EM playbook, like a commodity play.
Yeah.
And
EM's doing really well.
EM did well this year, right? And
Yeah.
but so did Canada. And
Yeah.
but I would say it may take some time to see sort of statistical proof that we are turning the corner in order for that consensus to move. But for us, we view that as an opportunity, right? So if we can be neutral Canada right now, and those security selectors that we use, the great building block managers we use in our funds, can pick this name instead of this name, that'll boost the performance of our fund.
Tell us about EFA more broadly. So taking us largely to Europe, but other places as well. This is the international story, is something that you were well ahead of, caught it.
Yep.
The question is sort of, where does it go from here? Does it continue? How are you allocated and invested towards that?
So right now, the EFA region, and if we talk about Europe, is the largest overweight on the equity side of our funds, right? So, and that's been there really since the start of this year, or the earlier part of this year, when we thought, you know what, valuations are an important input into our investment process, our asset allocation investment process, but valuations alone are not enough to drive an allocation decision.
Which has been the Europe story for
it
a
has
very
been forever.
long time. It's cheap.
It's been the story forever.
Yeah.
I mean, same as emerging markets, right?
Sure.
And I've joked that we've waited a long time for emerging markets to emerge.
Yeah.
Right. But
look at them now.
Look at them now.
Yeah.
But same, the same story I would say is there in Europe, attractive valuations. And I heard this when I was a researcher working down in Boston. We'd do this Europe research trip, and I'd hear this every single year: attractive valuations, and we're about to turn the corner with these great structural reforms. And as asset allocators, we have to think in these relative terms, right? So for us, what an attractive valuation requires is some sort of catalyst.
Okay.
And earlier this year,
to diversify,
right?
Essentially.
To sort of re-rate those stocks, right? And we believe what we saw earlier this year was that catalyst, right? Europe, removing extreme fiscal restraint, defense spending kind of hooking higher, and the performance in Europe this year has not just been defense, right? It's been the banks as well, and so we've leaned into that this year, and that's been additive to the performance as well. But to your question, how long can this be sustained? And is the gas out of the tank in terms of Europe? Because for the last couple of months, Europe's moved sideways, right? Yeah. There was a lot of return, but it's moved sideways.
It was cheap, got bought, and then it's sort of
flattened out. This is where working with our researchers is so critical because, as the funds move incrementally, and over time, if we see different signals, right? If we see that the wind has come out of the sails of Europe based on our research, that overweight would change, right? But as of right now, it's still a pretty significant overweight.
So interesting. So 2026 is a story. Europe is in it significantly.
And Europe was, to be fair, I mean, when people used to ask me about Europe, I'm not sure if I can say this, but when people used to ask me about Europe, I would say Europe's a wonderful place to visit and a terrible place to invest, right? So I love going to Europe. Yeah. But anyone who's allocated to Europe instead of the US over the last 10 years is poorer for it.
So let's go to AI and discuss. Actually, you're going to tell us a little bit, give us a sneak preview of a report that you're working on. I think it's not due out to the new year. But the question for months and most of this year probably is AI a bubble for sure? I know that's something you'll start with. So let's go there because it's part of the catalyst question for diversifying around the world and anywhere else, really.
Yeah, I mean, and again, these thought leadership papers that we publish once a quarter, I know they're very well read, and we take a lot of time and a lot of effort to pull in research and our latest thoughts to really address the questions we're getting. I spent a tremendous amount of time on the road this year. I mean, the most I've ever spent in my life.
How much?
I'm at the end of next week, I'll be at 90 flights.
Oh
So,
gosh,
yeah,
for 2025.
yeah, and I think I'll hit 90
Okay.
nights in Marriott's this year. So
Yeah.
I don't know if that's a good thing or a bad thing.
Well,
Probably a bad thing, but you know, the conversations that I've had with thousands of advisors coast to coast inform what we choose to answer in these papers. Our goal in these papers is we want to answer exactly the questions that we're getting in a jargon-free manner, right? So using the Bloomberg way, so to speak.
Yes.
You know, jargon-free and in the most accessible way possible, so that these are helpful to advisors. And even in the case that, you know, an advisor may disagree with our view, at least they fully understand why we have the view. And so one of the questions we've been getting quite a bit is AI a bubble? And for this, you know, we have to look at, again, the researchers that we work with. One of the pillars in our investment process is a bottom up. So myself, David Wolf, David Tulk, we all come from the macro world.
You all incidentally come from the Bank of Canada.
That's right,
as well,
right. So
fact, yeah.
you know, 20 years of experience roughly combined at the Bank of Canada,
Bloomberg.
and Bloomberg. But what companies are saying and doing matters just as much, right? I mean, as an economist, it's a bit humbling to say what a company is saying and doing today shows up in the economic data 6 or 8 weeks later. And earnings revisions, particularly in the US, have been pushing higher, right? And for that reason, we have to really push back on this idea that the AI expansion is strictly a bubble, right? It could be this sort of once in our lifetime productivity innovation that we can't necessarily lean away from. So in terms of what that means for positioning, we are underweight the US equities right now, but it's a bit nerdy, but we can use futures overlays to short out specific parts of the market, you know, perhaps small cap, right, which are not overly profitable, and keep great managers like Will Danoff, Mark Schmale, who are invested in the AI themes, fully invested,
right,
and benefit, and we can still benefit in our funds from that theme.
Without having to be all in on that particular discussion.
Right,
but you wouldn't be there, for instance, if you thought, you know, which they aren't, investing in a bubble.
No, exactly. And I mean, again, we work really closely with our underlying managers and our researchers to examine this very closely. But it speaks to the importance of having diversified sources of returns, right? So, I mean, our concern really in the US is, I would say, more to do with some of the underpinnings of exceptionalism coming under attack, right? A politicized Fed, what that might mean. And for us, that's really also resulted in a significant change in how we're positioned around the Canadian and US dollar.
Okay. Just say a bit more on that, because that has to do, I mean, I don't think it's a secret that the administration in the United States, it appears, has a real bias to getting the dollar, its value has gone down, and they sort of like that, and that seems to be a directionally thing that you maybe could count on.
Exactly. So, I mean, you know, when I was at the Bank of Canada, we had this term, this is also pretty nerdy, called observational equivalence. Okay. It's like if for example, if I go into a party and I come to say hi to you, and you turn your back and you snub me, you haven't told me you're being kind of a jerk, but you're observationally equivalent to one. Right, and so this is the idea of observational equivalence.
That's not me.
Right,
yes.
right. but and I'm making a big assumption that I'd be the same party as you. But and so in terms of observational equivalence, everything that the U.S. is doing we view as observationally equivalent to a weak dollar policy. Okay. So they haven't told us we have a weak dollar policy, but if you frequently threaten to fire the head of the Fed, if you fire the head of the statistical agency, if you criminally investigate a member of the Federal Reserve Board, if you add political appointees to the Federal Reserve, these all smell like...
You want to talk about a duck here somehow.
Right, right. So these all smell like weak dollar policy, right? And so for that reason, if we think, you know, the value of the US dollar is likely pushing lower, and the credibility and safe haven status of the US is at risk, we don't want to expose our investors and our funds to any additional US dollar weakness. Okay. So we've changed our currency position pretty meaningfully.
Something, to go back to the central banks and some of the discussions yesterday, something I found fascinating, and I don't know if it's just me, but Tiff Macklem, as well as Jay Powell, essentially put into words the affordability crisis.
Mhm.
It certainly is an affordability crisis in a lot of ways. But they basically said, look, prices aren't coming down.
Right.
You need to get over that. Prices are not coming down. What we can do is create central bank policy, and and for the fiscal levers, those are there too, to have wages catch up with high prices.
Yes. Yeah. I mean, I talk
They've
on the
never
road.
said that before. They
No.
blamed it on groceries.
Yeah.
And it's not a judgment call, but they were so clear.
Mhm.
Why were they so clear?
Yeah, I think my sense is, again, in having hundreds of conversations through the year, is I'm not sure Main Street has as strong of an understanding around inflation than perhaps central banks think, right? And what do I mean by that? Inflation, we know this. Inflation measures the rate of change in the price, right? So the price today, the price 12 months ago, that change is the rate of inflation, right?
Which is benign, but the prices went up massively in
Exactly,
COVID.
right. And you
And
can
have
measure
never come down.
right, and you can measure prices from a month ago, 3 months ago, 6 months ago, 12 months ago, any period. I mean, it's just a data series, right? And one of the things I talk about is when I say things like, oh, for the Bank of Canada, inflation is roughly where they'd like it, a lot of people will kind of furrow their brow and raise an eyebrow. And the reason for that is everything is so much more expensive, right? So think about the price of anything now versus pre-COVID. It's at least 20 or 25% higher. Cars, groceries, houses,
Snow boots,
right? Shovels, everything is much more expensive. Nothing is coming down in price. Things are getting more expensive at a slower rate, right? So central banks are tasked with controlling the rate of inflation, which is the rate of change in the price. And what they discussed was ideally what you have, so you've had this huge increase in the price level. Ideally, you have wages catch up, right? And if you can have strong growth, strong productivity, and wages catch up, then every single year that shock to the price level that we've observed and experienced gets a little bit easier to handle.
Right. And you invest in your fund, which has some of the companies charging those very high prices.
No, exactly. And it goes a long way in explaining why we still maintain inflation protection in our funds, right? Gold, tips, things like that.
Tell us just a little bit about that allocation right now, because it reflects how you feel about inflation.
Well, absolutely, right? So this is neat for me, having done the research when I was a researcher and then now seeing it on the implementation side.
Inflation is your favorite.
It is.
It's
I don't know.
Your
I'm not sure what that says about me either.
Well, it's pretty interesting.
But there is really no better asset class to protect against the damaging effects of inflation than commodities, specifically gold, right? And if you want to see what the damaging effects of inflation are, rewind to 2022, right? Totally. To me, the most damaging effect is it messes up the inverse correlation between stocks and bonds, right? So
they
stocks
slid together.
Right, and they suddenly move together. So 2022 was both of them going down, and since then it's 2023 was certainly both of them going up. But you need diversifiers in the presence of inflation, and for us, the top of that list has been gold on the equity side and tips on the fixed income side.
I've only got a minute, so sorry about this. Big story for next year is obviously the trade deals, CUSMA, USMCA, whatever you want to call it. It needs to get renegotiated, it appears. Do you think we'll have a broader, like America's North and South trade deal? What do you think is going to happen on this platform of discussion?
I mean, this will be the topic of next year. That and whether or not we're starting to gain some sort of escape velocity in terms of growth in Canada. But this is the topic to watch, and our plan is to, again, work very closely with our researchers and communicate those takeaways and findings here on things like FidelityConnects.
And you'll be there before we are anyway, because you see it first. Okay. Happy holidays to you. Happy New Year.
Yeah, to you too.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.